I'm going to give you 3 tweaks that you can implement into your structured trading from today to help you give more clarity and a better direction when you're trading. Now, if you're ready to take that structure to new heights, then do check out the 90-day fix program. Right now, we're open for enrollment. Only 4 spots left this month. Once they're gone, we'll close again until the following opening. You can find out more on that as a link in the description of this video. So the first tweak I'm going to share with you is going to help you with clarity in your trading is whenever, and I mean whenever you start to mark up a chart, always start with your highest time frame of choice. Going to give you more clarity. So what I'm going to do, I'm going to go through and walk this through on the USD chart here on a daily to show you exactly what I mean for each of these different tweaks was going to help you going forward. So right now we're looking at a daily time frame. That's my higher time frame of choice here. My middle time frame is going to be the 4-hour time frame with an entry time frame of a 30-minute. So we first look at marking up the daily time frame. Don't start on the lower time frame and then work your way up. It's not going to give you the clarity you need. You want to be seeing the directional bias first on that higher time frame. So if we look at where we've got this previous break of structure here, in fact, let's just place this on a magnet so we know it's in the right place. Yes, definitely a break of structure. We can see this is a valid break to the upside. We have a pullback and another valid break to the upside. So now we have the next break of structure. So right at this point in time, before we see this price action, we're in a bullish bias. What do we need to see for this to shift bearish? We need to see a break to downside. That's what we've just now seen. So without even looking at a lower time frame here, we now can identify that this higher time frame has had a shift to the downside, putting us into a bearish bias. So let's say you're looking at a lower time frame and you've marked it off and you're seeing a bullish movement, a bullish trend, and you haven't looked at this daily time frame and you haven't gone up and looked for that clarity and you're looking to just buy the lower time frame because you see this big candle to the upside on the lower time frame is going to show you a trend. That's where you're going to get into those losing positions because you're going to just jump in going with that trend, not looking at the higher time frame. That's why it's always important that we start at the highest point of your top-down analysis every time. Now we know that we're bearish here, we can mark off our current high and just mark this off as our current daily strong high. Now that brings us when we're talking about our tweak number 2 here really in this video is whenever you're marking out your current structures, you want to be marking out your current swing in the market. So what I mean by current swing, we've found this as our last break of structure. This is then our current high, which breaks this structure. That means this is my current swing in the market, what we call a trading range. This is the next tweak you want to be implementing right now. Is forget about all this previous price action. Yeah, we can use it to identify where the last break of structure is, like I just did, and I showed you that step by step. But now we don't need it. We don't need that on the chart. Why mark up all those highs and lows when you don't need all those levels? All you need, plain and simple, is that last level to be broken. Then we'll work out where our current trading range is. And this is our current trading range high. Now to find our low is very simple. And if you're not sure how to mark up this structure using my smart money structure, there will be a video coming at the end of this video. So stay tuned for that. Walks you through it step by step. But this becomes the current low in this actual move. So we call this a weak low. So my actual trading range is then from this high to this low. And it's important that you know where that current move is, where you're marking off that closest high and low and where our break of structure comes from. This is that tweak number 2. Always look for your closest high to low. We're still going through that tweak number 1 here, where we're walking through, marking that top down through the highest time frame to that entry area. But now we can walk down from this point to the 4-hour time frame and we can start applying the 2 areas. So we're going to go down now to the 4-hour and we'll walk through those first 2 tweaks again. So now we have our current daily low and our current daily high and our break of structure. Now we're going to zoom in and we're going to look at our lower time frame. So we can do the same thing again. There's our last break bullish. This is our last break to downside. This is a 4-hour break of structure bearish. We continue down. We have a pullback here. This becomes a new break of structure. So straight away, as soon as I see this, we can remove this level. We don't need it. Now what happens is the market goes down. We have a pullback. This just becomes a sweep in the market. So this would be a liquidity sweep in the market to run price higher, where we then break structure again bullish. So once you have this marked out, this is the next step. We've gone from the highest time frame. This is the next highest time frame in your sequence. We now get rid of the closest area. All we need is that last break of structure, don't we? We need to see where that last break of structure is, and we need to see where the current high and low is. We don't have a valid high, but we have a valid low. So the valid low is going to be the same place. So I'm just going to pop back to a daily. We're going to mark this off on the current time frame only, back to the 4-hour, so we can then apply, this is our current 4-hour low. So that's my 4-hour strong low in this market. And just find that strong low. So now we have our current start of our trading range is from this low. We don't have a valid high yet until we see a pullback, and you'll learn why and how this works in the next video coming up. But this would be the potential start of that current trading range. Remember, that's tweak number 2, your closest area where price is to find that current trading range. That's what we want to do. And you want to keep it clean, the closest levels. We don't need any more. So we start zooming out, we can identify we're bearish here on the daily, currently bullish on the 4-hour time frame. Then we go down to the 30-minute. This is really where we start fine-tuning things down, where you're going through that tweak number 1. You start with your highest time frame, work your way down through those time frames. We can see a bullish move here to the upside. So we can see where the market's dropped down. We can mark this low. That is a sweep of the low. So we can mark this out as a liquidity area that sweeps. That means this is still my last break of structure on a 30-minute. So I can mark this off as a 30-minute BOS in the market. And then we have a new break here to the upside. So what do we do as soon as we see this shift in structure? We no longer need that level. And we see that break to the upside. Again, we see a pullback, and we can mark this out as another break to the upside. So now we can get rid of this level here. We want that closest area, don't we? So the same thing can apply. We're going to pop back here quickly to the 4-hour. I'm going to mark this level again, just to show you. We'll put this as the current interval, so we don't see it on the 30-minute. When we see this break here to the upside, this would have been the original 30-minute strong low. So that's where we'd have seen the strong low on the 30-minute. Now we've seen a new break to the upside. This becomes the new strong low. And we also have a weak high that we can mark off right there. So now we've formed that area we're looking for, which is our last break of structure and our current trading range, those two levels. So now all we've got on this chart is simply those levels marked we have here on the daily. Remember, there's a low down here, so we'll just go back. Now I've moved it. We'll put this back again. Mark this out as a weak low, no, sorry, strong low in the market. We go back to that 30-minute. We can now identify there's our daily range, there's our 4-hour range, and there's our 30-minute range. Clarity keeps it simple. You're reading the structure closest to you. Forget about all those other lines and levels. You don't need them. So there's your clarity for understanding the tweak number 1 and number 2. Now, the third thing you want to be looking for is don't make any decisions on any trade setup before we wrap up. If you're tired of second guessing trades or still wondering why structure isn't clicking, this might help. I built a full 90-day system that turns structure into something you can actually trust, not just theory. It's what helped Danny rebuild after losing nearly 300,000. He didn't just learn structure, he finally knew what to do with it. If that sounds like where you want to get to, the link is in the description. Apply for access when you're ready. We've had a break of structure. So what do I mean? Once we see this 4-hour break of structure to the upside, then we can start looking where we have a potential area where price could pull back into. Now, whether that be an area of supply and demand, whether that's an area of imbalance or liquidity area to be taken, it doesn't matter. It's as long as you understand you're waiting for that break of structure, because after a break of structure, price can pull back at any time. So again, here, 30-minute break of structure. What do we see after the break of structure? One candle breaks up, through sideways, we have a pullback. Now we could come deeper here yet, because we would have, let's grab this tool, we have an area here of potential demand. Now, price is tapped in once, come back towards it again. We could come deeper again before we see a run higher. Ideally, we're looking for continuation to this high. But that's understanding that now we've made that break of structure, we can start to set up our chart to look for that entry. And we can go down to lower time frames even from here. Start fine tuning. Where do we have an area of demand down here where price could pull back into, taking these equal lows of liquidity. Let me just go back. I'll mark it out and show you. Let's say we have an area of demand down here. Let's say we've got these equal lows that we can mark off here. Not quite there, like this. So we'd have some liquidity sitting at those lows. What is below those lows? We have liquidity. So we could see price want to push down through those lows into an area of demand to continue up. That's just understanding the way the markets move. So there are your 3 tweaks to use going forward. Always start with your top-down analysis with your higher time frame. Always start there, making sure you're looking for that last break of structure, which was that tweak number 3, before you look at making any decisions. And also just look for those 3 levels: your break of structure, your valid high and low. That's all you need on every single time frame, nothing else. Now, like I said, as we were going through this video, if you're not sure on this actual structure, check out this video coming up, and I go through step by step the exact way we look at marking it up and how to apply it on your chart.